$1,000 into these three stocks could surpass your full-time job. I'm not a financial advisor, but some financial advisors might say to buy as much as possible before December 25th. Now, the market's been stuck going sideways for almost 3 months, but I've got 3 top stocks and 3 secondary picks that I think are well positioned to kick into high gear when the Fed starts the money printer in 2026. Here's what you need to know right now. Capital One is a fintech that is going to benefit from credit expansion and lower rates. Ticker symbol COF. Robinhood, ticker symbol HOOD, it basically does well whenever retail is very excited, and they're often excited at the beginning of a new year. Carnival Cruise Lines, ticker symbol CCL, is a consumer discretionary play that benefits every time consumers open up their checkbooks. Micron is an AI memory play that has 70% margins and just had awesome earnings despite people talking about a so-called AI bubble. Cleveland Cliffs, ticker symbol CLF, is an inflation hedge. And Alcoa, ticker symbol AA, is an aluminum producer with exposure to the data center infrastructure build-out. The main tickers that can benefit from stimulus spending and lower rates are Robinhood, Capital One, and Carnival Cruise Lines when people want to go spend their money. But all 6 of these stocks directly benefit from what happened this past week and are poised to be the best opportunities heading into 2026. Let me show you why. On Wednesday, December 18th, the CPI report dropped. Inflation came in at 2.7% year over year, below the 3.1% consensus forecast. Core inflation hit 2.6%, the lowest since 2021. On Tuesday, December 16th, we got delayed jobs numbers. The unemployment rate jumped to 4.6% in November, the highest level in 4 years. The economy added just 64,000 jobs in November compared to 105,000 in October. And 10 days ago, December 10th, the Fed dropped interest rates by 25 basis points, the 3rd cut this year. The federal funds rate is now at 3.5 to 3.75%, down from 5.25 to 5.5% back in September 2024. Here's what Wall Street isn't telling you. The market has been trapped sideways since October, as everyone waits for the Fed to tell us what's going to happen. Well, guess what? They just showed their cards. Inflation is rising, employment is falling, the Fed is cutting rates. And although they signaled only one more cut in 2026 in their projections, don't believe that for a second. When unemployment hits 4.6% and looks like it's going to keep rising, the Fed has to cut more than once. When the government is paying $1 trillion on interest on its debt alone per year, they have to keep interest rates low. The money printer is about to turn back on. This is the SPY in the last 2 to 3 months. And you can see we've basically gone sideways. It only now looks like we're starting to turn up. America owes $37 trillion. That's $280,000 for every household. And the government does pay $1 trillion per year just in interest pay. That's more than we spend on defense. Here's the reality. They can't pay it off. So what do? They inflate it away. Think about it. If you owe somebody $100, but you can't pay them back, well, if you wait for inflation to take its toll, you only have to pay them $50. The debt number stays the same. The dollars lose half their value and the purchasing power drops. This is the delicate balance the Fed is always skirting in this made-up system we call the monetary system. Trump keeps claiming the US can hit 20% GDP growth. That sounds insane, right? Real GDP growth is 2 to 3% per year. A great year is 4 to 5%. But in reality, here's what he's actually saying. Nominal GDP growth. Nominal GDP growth includes inflation. 3% real growth plus 17% inflation equals 20% GDP growth on paper. Trump gets to claim economic success. The media reports the big number, but your paycheck doesn't buy more eggs. Gas goes up. Your rent costs more. And you know what looks amazing during that whole shenanigans? Asset prices. The 50% of Americans who own assets, stocks, gold, real estate, all benefit. Assets inflate with the currency. Broke people don't own assets and they get left behind. The bottom 50% that Trump purports to speak to gets absolutely hosed. This is the plan, and it's already happening. So how can you get yourself in the 50% of asset holders? The Fed blinked. They showed their hand. They cut rates December 10th, even though inflation is still at 2.7%, above their 2% target. Even though the economy is still growing. Even though employment was still at 4.4% during that time. Why cut when they didn't have to? Why cut during that environment? Political pressure. Trump's Commerce Secretary, Howard Lutnick, aka Cantor, publicly attacked Fed Chair Jerome Powell. He told him to, quote, do your job and cut absurdly high interest rates. Cabinet members don't do that. The Fed is supposed to be independent. But Lutnick doesn't care about independence because lower rates pump asset prices. And guess what? The Fed listened. They cut rates. The vote was 9-3. Just 3 members dissented. It was a divided vote, but the majority won. Now we got fresh data this week showing unemployment at 4.6% and inflation at 2.7%. Unemployment rose, inflation fell. Translation, the Fed is going to cut way more than expected. Plus, Jerome Powell's term ends May 2026. Trump's likely pick is Kevin Hassett. He's very dovish. He said on Fox News that if he were at the December meeting, he would advocate for a 50 basis points cut. All this means the money printer is turning back on in 2026. Here's what happens when the Fed floods the system with liquidity. Cash becomes less attractive. Real yields get pushed down. Savings accounts earn less. Money market funds earn less. You're forced into risk assets just to keep up. Asset prices get bid up. Stocks, crypto, real estate, commodities, they go up. When there's more money chasing the same amount of assets, the prices have to rise. Simple supply and demand. The inflation hedges outperform. Gold, silver, Bitcoin, hard assets that can't be printed. Basically, everything goes up that is owned by the top 50%. You might look at the S&P and say, how can it go higher? We're already at a 30 price to earnings ratio. But here's what you need to get. In a liquidity-driven environment, valuations get even more insane before they come back to reality. That's exactly what happened in the dot-com bubble. And here's the thing, when it comes to actual earnings, we're nowhere close to dot-com bubble valuations. There's a lot of room to the upside before we get to 1999, 2000 levels. When NVIDIA, the leader in AI, tracks similar to Costco and Home Depot as far as valuation, it means we're not even close to the top. How can NVIDIA have a similar multiple to these staple stocks that have been around forever? It suggests that a melt-up is not even close to happening yet. With NVIDIA at similar multiples to these stocks, we haven't even started the melt-up. Now there's 6 stocks positioned to explode when the Fed opens the liquidity floodgates. The first is Capital One, ticker symbol COF. They just completed the Discover acquisition. They now have a proprietary payments network. They have an expanded credit card leadership, and they're expecting $2.5 billion in synergies. They have a forward PE of just 12x, despite 20% forward growth. And they just increased their dividend by 33% to 80 cents per share. When the Fed cuts rates and injects liquidity, lending expands. Credit card spending accelerates. More people take out loans, mortgages, and car financing. Capital One profits from every swipe. Lower rates mean lower borrowing costs for consumers. Lower borrowing costs mean more spending. More spending means more transaction volume, more interest income, higher profits. Plus, when crypto booms, which it will with all this liquidity, Robinhood account holders need to fund their accounts. Like it or not, credit card spending on financial apps explodes. If Capital One can break through the $320 level, the party is on. The second stock to benefit from this liquidity is Robinhood. When rates were high at 5%, people parked money in CDs and treasury bills. Now rates are dropping. That money is moving back into stocks and crypto. Lower rates mean more margin loans, more active trading, and more transaction revenue. Robinhood's Gold subscribers grew 75% year over year to 3.5 million. As the Fed injects $50 billion starting in 2026 per month, according to Evercore's prediction, retail markets are going to explode. Money flows from their saving account into their Robinhood account. In the name of returns or chasing returns, there's more volatility, more trading volume, more money for Robinhood. Plus, regulatory clarity for crypto means more crypto trading on Robinhood. That's Robinhood's highest margin business. When asset prices inflate and people see stocks going up 20 to 30%, people's FOMO kicks in. Retail volume trading explodes. Robinhood's the primary beneficiary. The third beneficiary is Carnival. Carnival Cruise just reported record full-year results. They reinstated their dividend for the first time since the pandemic, 15 cents per share. They're projecting 12% increase in adjusted net income for 2026. Cruises have a 25 to 30% cost advantage over land-based vacations. Customer repeat rate is over 80%. And bookings for 2026 are already at record levels. 2/3 are already booked at higher prices. What happens is the Fed cuts rates, everybody is flush with cash, and they want to spend that money. They feel richer and they spend it on experiences, like a cruise. Lower interest rates means financing vacations cheaper. Consumer confidence is rising despite the sideways market. When lower interest rates hit in 2026, and especially if there's stimulus checks, consumer spending accelerates. Carnival's debt to EBITDA ratio is down to 3.4x. Fitch just gave them investment grade recognition. Balance sheet is repaired. Free cash flow is growing. They're returning capital to shareholders. CCL, Carnival Cruise, is a leveraged play on discretionary spending acceleration. The fourth play is Micron. Micron just had excellent earnings. Stock is up 64% in 3 months. Just hit an all-time high. And margins are 70%, similar to NVIDIA's margins. Micron makes memory chips, DRAM and NAND. Every AI data center needs massive amounts of memory. Every smartphone, every PC, every server. The AI boom is real. Memory prices have tripled since 2023, and demand is outpacing supply. When the Fed injects liquidity in 2026, data center buildouts finally have the capital to get built. Lower rates make it cheaper to finance massive infrastructure projects. That drives memory demand even higher. New laptops, maybe new AI. Plus, when consumers have more money from potential stimulus, they buy new phones, new PCs, new cars with AI features. All of that needs Micron's memory chips. In a liquidity-driven melt-up, high-margin businesses like Micron absolutely explode. Fifth stock is Cleveland-Cliffs, ticker symbol CLF, America's largest flat-rolled steel producer. They supply automotive-grade steel. They just announced a strategic partnership with Korea's largest steel producer. They're exploring rare earth minerals in Minnesota and Michigan. This could make them a strategic critical materials supplier. When the Fed prints money, commodity prices rise. When inflation accelerates, hard assets like steel benefit massively. Steel producers get the gains. Infrastructure spending is coming. Ukraine reconstruction. US manufacturing reshoring. All of that needs steel. Plus, if tariffs on foreign steel stay in place, domestic producers like Cleveland-Cliffs get a major bump up. They have massive pricing power. The stock is up 100% from its 52-week low, but it's still below its high. As the Fed injects liquidity and inflation rises, steel will pick up. As steel prices rise, Cleveland-Cliffs is leveraged to that move. The sixth stock is Alcoa. Alcoa is the largest aluminum producer. They just got government approval for a gallium critical mineral project in Western Australia. Aluminum demand is exploding. EVs need aluminum. Renewable energy projects need aluminum. Defense spending needs aluminum. With China controlling rare earth exports to the US, Alcoa's gallium mineral project becomes strategically important. Lower interest rates make aluminum production cheaper because it's energy intensive. And when the Fed injects liquidity, infrastructure spending drives demand. Alcoa is both an inflation hedge and a strategic minerals play. Here's what connects these six stocks: Capital One, Carnival Cruise, Alcoa, Robinhood, Cleveland-Cliffs, Micron. Number one, they benefit from lower rates. Financials profit from lending expansion. Tech companies finance growth cheaper. Consumers borrow to buy. Commodity producers reduce production costs. Number two, they benefit from liquidity injections. The Fed buys $50 billion per month in assets. That cash flows into lending, consumer spending, and corporate investment. Number three, they benefit from inflation. When dollars lose value, hard assets and real businesses gain value. These companies have pricing power. Number four, they benefit from the wealth transfer. As assets inflate and cash devalues, people move money into stocks, experiences, and real assets. We've seen this playbook before. In 1982, the Fed crushed inflation from 16% down to 3%. Then they pivoted. They cut rates. They expanded the balance sheet. The market bottomed in August 1982. What happened next? An 18-year bull market. Investors made over 1,000%. Phase one was recovery. Jobs came back. Corporate profits rebounded. Phase two was the tech revolution. The internet transformed everything from 1995 to 2000. The NASDAQ went up 600%. We're in the exact same setup right now. We just went through the pain. Inflation crashed from 9% to 2.7%. The Fed tightened aggressively. Unemployment ticked up to 4.6%. The market's been sideways since October, but now the Fed is pivoting. It's 1982 all over again, except this time, instead of the internet, we've got AI. And instead of dial-up modems, we've got data centers with memory measured in the terabytes. So here's what to do right now. Number one, follow the liquidity, not the headlines. The Fed might throw out terms like reserve management or technical operations. They can call it what they want. If the balance sheet is expanding and money is flowing into the system, stocks are going to go up. The market treats it like a stimulus. Number two, don't chase parabolic moves. Even in a melt-up, there will be 10 to 15% pullbacks. Smart money buys dips, not tops. You don't have to time the exact bottom. Just avoid chasing euphoric moves. Number three, diversify across these 6 plays. You've got financials, consumer discretionary, tech, and commodities. When liquidity floods in, multiple sectors go up. Don't put everything in one basket. Number four, be careful with margin. Even in a melt-up, there will be volatility. If you're leveraged to your neck, a 15% drawdown can wipe you out. Don't do it. Number five, have an exit plan. Valuations will get stretched. Euphoria will kick in, but eventually the music stops. Have a plan for taking profits. The biggest risk isn't that these stocks don't go up. The biggest risk is that the Fed inflates too fast and we get runaway inflation. Your stocks go up 100%, but bread costs 200% more. If you're not in the top 10%, 1% of Americans, that's a real problem. Grocery bills matter. The second risk is they don't inflate fast enough and the government defaults on its debt. Bond market crashes, stock market crashes. Bad for everyone. But here's what I know. They have no choice. They have to inflate. The alternative is catastrophic default. So they're going to choose inflation. They're going to choose lower rates. They're going to make asset holders rich and cash holders poor. That's not fair, but it's what's happening. The wealth transfer has already begun. The people who position themselves in these 6 stocks will benefit. The people holding cash will watch their purchasing power evaporate. I can't tell you what to do. I'm not a financial advisor. This is your choice. But some financial advisors might say to buy as much as possible of Capital One, Robinhood, Carnival Cruise Lines, Micron, Alcoa, and Cleveland Cliffs before December 25th. Like this video if you like these types of videos. Hit that subscribe if you want to stay up to date, and head over to stockscommunity.com to join the #1 Discord for busy investors. That $25 offer won't be around forever. I'll see you in the next one.